Your savings account is working hard, just not for you. Right now, your bank pays you roughly 0.5% on a standard savings account. The national average sits at 0.41% per the FDIC. That same bank takes your deposit, pools it with millions of others, and lends it out at 8, 12, 18, even 21% on credit cards and personal loans. The gap between what it pays you and what it charges your neighbor is not a coincidence. It is a business model, and you are the raw material. Here's how the math works inside the bank. Every dollar you deposit costs the bank roughly 0.41 cents a year to hold. That same dollar, lent out as part of a credit card balance at 21%, earns 21 cents. The spread between those two numbers is called the net interest margin. U.S. banks have averaged a net interest margin of roughly 3 to 4% annually for the past decade. On a deposit base of trillions of dollars, that margin is the single largest source of bank profit in most quarters. The bank is not offering you a savings account as a service. It is purchasing your cash at the lowest price you will accept. Your inertia is their income. The high-yield era did briefly change this. When the Federal Reserve hiked rates 11 times between March 2022 and July 2023, the best online banks offered 4.5 to 5% APY. That looked like a revolution. But watch what your traditional bank did during those same months. It passed less than half of those hikes to you, slowly, partially, and quietly. Your rate crept up. Then, the moment the Fed started cutting in late 2024, your bank moved fast in the other direction. Savings rates dropped within weeks. The hike to you came slow. The cut to you came fast. That asymmetry is not an accident. It is policy built into the deposit business model, and it has been consistent across every rate cycle for the past 30 years. Here's the part your bank really does not want you to think about. The interest your savings account earns is not your return. It's a gross figure before two invisible cuts. First, taxes. Interest income from a savings account is taxed as ordinary income, the same rate as your salary, not the lower capital gains rate. If you're in the 22% federal bracket, you keep 78 cents on every dollar of interest earned. At 24%, 76 cents. Add state income tax, and a typical middle-income earner keeps roughly 70 to 75 cents on every dollar earned. Second, inflation. If your account pays 4% and inflation runs at 2.7%, your real return before taxes is only 1.3%. After taxes, most middle-income savers are capturing somewhere between 0.8 and 1.2% in real purchasing power gains per year. That is not nothing, but it isn't the number on your screen either. Then there's what banks call the loyalty penalty, though they don't call it that. Banks routinely offer their best rates to new customers through introductory rates, promotional yields, and sign-up bonuses. Customers who have been with the bank for years, who set up direct deposit long ago and never thought to look again, are almost always earning less than someone who opened an account last month. Your bank is betting that the friction of switching is worth more to you than the rate difference, the effort of moving money, updating direct deposit, changing autopay. For most people, that bet is paid off. That gap is not accidental, it's priced into the model. Here's what your bank does not show you next to its savings account page. Treasury bills, short-term U.S. government debt maturing in 4 weeks to 12 months, currently yield rates competitive with the best savings accounts, with one structural advantage. The interest is exempt from state and local income tax. For a saver in a high-tax state, that exemption adds 50 to 100 basis points of after-tax return on the exact same balance. I-bonds, issued directly by the U.S. Treasury, adjust their yield for inflation every 6 months, a direct hedge against purchasing power loss, capped at $10,000 per person per year. Money market funds holding Treasury bills offer the same liquidity as a savings account with the same tax advantage. None of these appear in the rate comparison your bank publishes on its homepage. The final piece of the model is the one most people feel but never name: your savings balance being inert. Not just that you won't withdraw it, that you won't even think about it. The balance sits, the rate compounds slowly, you check it far less often than you check your investment account. The mild satisfaction of a number that goes up each month, the trust of a known institution, the friction of moving, all of it works in the bank's favor. Your comfort is the product. Your indifference is the margin. So what do you actually do? Keep 3 to 6 months of real living expenses in a savings account. That money must be liquid, insured, and reachable within 24 hours, and a savings account does that job well. Any cash above that threshold, money with a time horizon longer than 60 to 90 days, should be working harder for you. Move it to a high-yield online bank, a treasury bill ladder, or a money market fund. When you compare accounts, compare after-tax yields, not headline rates, and check your rate at least once per quarter. Your bank won't send you an alert when it quietly lowered it. Your savings account is not your enemy. It's a tool being used in the wrong role at a rate your bank set for reasons that serve its margin, not your future. The model only works while you're not paying attention. Now you are. Follow the wealth logic.